Hi, this is Jeff Adler, and I'm going to cover a fair amount of material today on the U.S. economy and multifamily markets. So why don't we get into that? Okay, so we're going to cover the U.S. economy, inflation and interest rates, labor markets and demographics, affordability, multifamily fundamentals, our view and forecasts, and then a view of potential supply-driven distressed markets. If we think about where the economy is right now, the economic growth has been good so far, but it's been downshifting, and I expect it to continue to downshift. The Fed paused its interest rate hike campaign. It's kept rates steady, and we expect a cut in short-term rates beginning in September through the end of the year and into 2025. Inflationary pressures have been cooling. Prices, in terms of the overall inflation rate, have been decelerating, 2.9% in July. And it will continue to, but I would also say that housing costs are the long pole in the tent. Unit labor costs have been moderating. Productivity has appeared to be good. The labor market continues to loosen. Now, this was before we did this slide, before the restatement, which was not unexpected in hiring. And so there has been a deceleration in job growth. There's also been an increase in labor supply, leading to moderation in wages. And the unemployment rate has begun to tick up as well. So the 2023 population increase, which provided a temporary boost, all been immigration-based. And that really isn't a long-term solution, though in the short term, it is going to keep downward pressure on wages. We still have a lack of consensus on what immigration policy should be in the long run. And again, from the economic standpoint, I expect to see a continuous slowing the economy with a slow recession, early mid-2025. When it comes to what's happening in the multifamily world, what we are seeing is the rapid run-up in rents that occurred in 21 and 22 have resulted in the bleeding of affordable housing concepts into conventional housing, as public policy is attempting to deal with this issue. And when we cover now affordable housing and a wide range of housing as well, the multifamily market has performed not badly given the amount of new supply that has been delivered into about 15 markets or so. But demand has been pretty good, not at the same price as people would have wished, but I would say better than otherwise would have been expected. We are seeing a rotation involved in the Midwest and Northeast metros without a lot of new supply and decent demand. And they've had rent growth in the 3 to 5% range, which has been actually historically quite good. Markets that saw this rapid growth in rents in the Sun Belt, they also now have a rapid increase in supply. And it'll take about a year and a half, 2 years for that supply to get burned off. But after that, and with these economies being very vibrant, construction financing has been very short supply. There's going to be a drop in new supply in 26 and 27 and a spike back in rent growth at that time. And so the U.S. really hasn't net resolved a supply shortage. It's still there. It's going to continue to keep rents, I think, relatively healthy, rent growth healthy. And the distress that we see in the next 18 months has been sort of slowly beginning to show up, but it's definitely been by exception. So let's just kind of go into it. As I see things, I do think real GDP is going to continue to decelerate. Inflation is also coming down. There's different measures of that, the PCE, the CPI, the GDP deflator, but they're all gravitating to 2-ish or maybe 2.5-ish, put it that way. And probably enough that the Fed, as I expect, will begin to cut short-term rates. But I think because of the lagged effect of this, we will see an increase on the unemployment rate through much of late 24 and 25 before it kind of slops down again. We will see, right now, the 10-year rates in the 3.8-ish range. I think we eventually settle around 3.5 with short-term rates coming down enough that the yield curve kind of stops inverting and kind of has an upward slope to it, which is normal. If you look at inflation, inflation is definitely coming closer to meeting the Fed Reserve target. Again, if you took shelter out, you'd actually be at the 2% target. The shelter is really the long pole in the tent, and it really doesn't get better until there's some either change in the employment, which situation dropping demand, or so interest rates come down, so the housing market can kind of loosen up. But I do think if you look at new rents, they certainly are, generally speaking, throughout the United States, lower than the 2% number, but this measure does lag. And if you look at this, and we've looked at different measures of it, our in-place rents, which are a pretty good measure of the sort of total of new and renewal transactions, are pretty good, close to measure of what the Fed CPI housing and owner's equivalent rent tends to be. And that actually is definitely pointing down. And so this measure should come down as well. The whole supply chain disruption, that's pretty much easing. So it's not really a goods issue. Goods actually having goods deflation. We're back to the world of goods deflation, services inflation, including housing as well, which is a service. There has been a significant amount of construction spending and manufacturing, and that really is driven by the deglobalization that is occurring and will continue to occur as supply chains basically drift out of China, but slowly, and have to get repositioned in the US, in Latin America, and in other parts of Southeast Asia. Now, as we go to the US labor market, it is beginning to loosen, right? Vacancies are coming down. The quits rate has been dropping, and with that pressure. Now, the labor force participation rate for 25 to 54-year-olds is pretty high. It's actually higher than post-COVID, but the growing cohort of population, which is 55 plus, that unfortunately, labor force participation rate of that group, which we had expected to be able to increase, has not. And so that's really what's been driving the generalized labor shortage. This is being stopgapped right now at the lower end due to illegal immigration, at the upper end due to interest rates and reduction in business conditions. That's kind of what's driving that. Now, if you look at, and this is what I've been saying for a number of months, the employment picture is not as strong as it seems. And I did this obviously before the restatement on the payrolls report. But if you look at the payrolls report prior to the restatement, what you see is an increasing number of part-time jobs and an increasing number of the jobs that are being created in what I would call non-wealth creating sectors, like government, healthcare, and leisure and hospitality. And that is pretty significant. Now, take this down cumulatively over the past year, about 800,000, and you would see that has grown less than it otherwise would have in those sectors. And so I do see the economy, there's a lagged effect to the impact of interest rates. It does take time, and that time generally is 1 to 2 years, and that's where things are starting to bite right now. And another measure of this is I look at the household survey in addition to the establishment survey. The main numbers you usually see are the establishment survey, which is a total number of jobs created. Now, if you look at another survey, which is the employment situation of households, you'll see it's been flat pretty much since the end of 2022. And so that also indicates to me that, again, things have not been so good as they have been purported to be. The economy is a sort of slowing / weakening, but still growing off of its own momentum. But again, a cautionary tale about what's headed here. And these things do take time. You are seeing the West Coast and some areas in the Midwest, unemployment rates begin to increase over other places. So again, a bit of a cautionary tale there. I do see this is one of the measures that is a pretty good look. If you look at the quits rate, it has about a 6-month lead time over where the employment cost index tends to go. And all of that is kind of bringing inflation in as the Fed would like to see. And I think we are seeing it. Productivity actually has spiked up some, which is pretty good. Therefore, unit labor costs have been coming down faster than otherwise would have been the case, which also sort of helps with the inflationary story. When we look at population growth, you can see this sort of like the Census Bureau and the CBO have different kind of time series. And so the Census Bureau doesn't really take into account the international illegal immigration, which occurred over the past several years. When you take that into account, you get kind of this spike in overall population growth, but I don't think it's sustainable and will kind of move back to its long run declining average. And when we look at this in terms of kind of a long run perspective, we do see that the growth in civilian, non-institutional kind of working age population is continuing to decelerate. And that means that we need productivity enhancements like AI to make up for the fewer number of new entrants into the labor force. And a lot of the immigration is coming from Venezuela, which is an absolute failed state and kind of a disaster. Fertility rates have been declining over the long run and are well below replacement rates. And in some places like Japan and Italy and Germany have been under replacement rates for 40 years. And so those populations are hitting the wall in terms of absolute declines in population, as is China, as not quite South Korea, but the US is more modest on this path. And that really does change the economic model, where productivity matters quite a bit more, and also where people are moving to. We still have an increasing population until 2040, but there is a time where we're going to have to begin to adjust to that reality. And this is the demographic profile of the United States. You can kind of see the fewer number of younger Americans, which will work its way through eventually into the entire kind of demographic stack. China is in a way worse situation. They are growing old way faster than any society in human history, and they are growing old before they get rich. And so there's a significant set of problems that the Chinese Communist Party is only beginning to grapple with. Now, in terms of migration, our state-to-state migration levels are kind of returning to sort of that pre-COVID kind of level where there is migration, but not at the same torrid pace that we saw in 21 and 22, and that is reflected in the kind of housing markets in other places in the U.S. But as a summary here, as we expected, this isn't rocket science here. The Southeast, Texas, Utah, Idaho, Montana, and Arizona have grown significantly. This is just 22 to 23. The same pace, same direction, lower volume as we move this year. And just because there's just been fewer home sales and the overall movement of people has slowed, not stopped, but slowed compared to what it was before. Now, when we move on to affordability, unfortunately, the big decline, and again, you can see the COVID impact of people moving around with inexpensive money, or moving from high-cost places to low-cost places, moved the price of housing up significantly. So even as rents went up, they went up a lot less than the equivalent cost of purchasing a home. And until there's some fundamental crack in the single-family home market, there may be some cracks emerging on a localized basis. Renting is still the much better choice than owning a home. That was not always the case if you look at this period of time, from 2010 to 2020. And this is just a notion of the significant run-up that occurred in asking rents right here in that 21 to 22 area. And it's kind of begun to kind of level out as rents have kind of peaked and flattened out. It is important to understand that from a cumulative basis, Class B or lower rent by necessity type product actually have had the higher run-up in rents. Now they also have lower margins, and so they don't necessarily yield as much from an investment standpoint, but they do tend to be more stable and less volatile than the A-class product. We are seeing a decline in affordability. This is data from our screening division, where average rent-to-income ratios have gone up about 4 points, and mostly on the folks that are the lower end of the economic scale, the rent by necessity group. And when we look at this at a market-by-market basis, you can begin to see that there is some significant, not in every market, but a dozen, 20 markets, where the income-to-rent ratios are quite high, indicating a significant affordability issue at the lower end of the economic scale, the people who've been hurt the most due to inflation of goods and services and fuel and food, and they have a higher proportion of their spending power spent on those items. They have been hurting. Now, when we move to what do you do about that? Well, there's some market-based responses, co-living, short-term rentals, conversions, and locally that's helpful, but you really got to build. The public policy is either you curtail demand, slow economic growth, you encourage supply, and there are beginning to be movements, particularly at the state level, to address tax incentives and to create some zoning reform. Federal market's really hard to do anything more than is being done without massive spending decisions, which some are on the table. The other approach is to regulate and suppress market forces, and that really never works, but it is being tried, and the long-term effects will take time to sort of squeeze out in those areas. Now, we do see an increase in conversions, and so that's kind of happening. We do track conversions. Actually, conversions from motels are actually far more important and interesting than offices, but offices is beginning to build, and we do collect data on the conversions, and yes, it is somewhat relevant, and you can kind of see where it's coming from, and the pipeline is going up, and I think will continue to go up. We've identified that there are some local programs attempting to promote that, but these are very expensive projects, very large projects, something you really wouldn't want to get into, and the product that does get delivered is pretty high-priced product. So it's not like you're talking about delivering true attainable housing. That's just not happening. Not relevant. We have developed this office to multifamily conversion feasibility index, and it does indicate, some number of buildings that can be converted. This is more for institutional investors. It takes a lot of money to buy one of these, and also to manage the conversion. And it is more, as you'd expect, a Manhattan, LA, San Francisco kind of thing, with some other properties in other areas. There is more of that. But again, I think overall, kind of smallish impact to housing overall. Okay, and affordable housing concepts are bleeding into conventional housing, and light tech really is the basis for that. And the GSE do have, and this is relevant, I think, for IRO, they have programs that if one will basically accept some income limitations, which may already, and quite frankly, not require any changes, there are financing incentives that could be quite meaningful. And so that's something to discuss with your loan officer about these programs. And there is some things on the table, maybe to expand the low-income housing tax credit to more sort of folks further up the AMI channel. Let's go quickly to talk about fundamentals, if I could. And so you kind of see this, leveling off of rent growth. Now, you still have a 24% increase in asking rents from the pandemic, but it has kind of leveled out over certainly on a month-to-month basis and a year-over-year basis. This is at a national level. There's variation significantly market to market. And if you look at this on a seasonal basis, which I do, it's kind of a weak seasonal uptick along the lines of sort of pre-pandemic years. So you've had this big run up. You're seeing now sort of a normal kind of seasonal kind of play out. As I would expect, right, at the back end of a cycle, renter by necessity, rent performance is better than lifestyle, because lifestyle is where the new supply comes in, suppressing the overall marketplace. So again, no surprise here. You can see this as this plays out by metropolitan area. The places that are performing right now in the Northeast and the Midwest had the weakest supply response of the country. The places that had the fastest run up in rents and now have also had the fastest run up in the supply response, their rents are declining. Tampa, Orlando, Nashville, Phoenix, Raleigh, Atlanta, Austin, very sort of like, names that you would know and recognize. And if we look at this from a lifestyle standpoint, it's more pronounced because of the new supply effect of the upper end, less so at the rent by necessity level. And it takes a tremendous amount of new supply, Austin, Phoenix, Nashville, for there to be a decline in rents this far down in the inventory stack. So being in sort of naturally affordable housing, naturally attainable housing, does provide an insulation effect from the new supply. This is an interesting chart, one of my favorites, just talking about what happened since the pandemic in some of the gateway markets, in some of the tech hub markets. And you can see significant increases, about a decade's worth of changes, an increase, and now it's kind of leveled out. Not at all surprising. Where occupancy is still, in places like Chicago, even 1 or 2% better than it was pre-COVID, and we're seeing sort of weakness as one would expect during this period of time in tech hub markets. Not a surprise. The tertiary markets like the Northeast and Midwest have been doing quite well. There's been a spreading of the U.S. population and not a lot of supply. And so these markets have performed generally well. There are some markets where there's been a lot of supply, Colorado Springs, Southwest Florida, Jacksonville, and those markets are going through certainly some pain for right now. When we look at the Midwest, these are places that, again, not a lot of supply coming in, steady Eddie kind of rent growth, looking pretty good as from that perspective, and as the Midwest has certainly gained more luster than it had in the high-flying days of the tech hub markets. When you look at the bigger sort of Northeast Midwest gateway markets, they've been performing pretty well. New York's done on its non-rent controlled, down stabilized sectors actually pretty well. Chicago as well, DC less so. Boston, quite well. So again, all things considered, these markets are performing well. They do have political risk, and you have to sort of structure your way around that risk. When you look at this on a national basis, from year-over-year rent growth, this is new lease transactions. It's kind of flattened out, right? You can see now the growth declining in place and renewals, but the overall level, right, and in place has just begun to flatten out compared to the transactions for new and renewals. This is something I take a look at just to get an indication of. This is a new lease trade out metric, which looks at paired lease transactions. And you can kind of see 2 bedrooms, right, which are somewhat of a complementary product to single-family homes. They have significantly outperformed the performance of studios, which are starter apartments when you form a new household and you're looking to get into it. So 2 bedrooms have performed much better, both on renewal basis and more to an extent on renewals as well. Absorption, as I kind of mentioned earlier, has actually been done quite well nationally. So the units that have been delivered have gotten absorbed. Again, not necessarily at prices people would have liked, but there has been sufficient demand to absorb those units. And so that's kind of where we're at now. Now, the other side of that, of course, is operating expenses have gone up. And in some markets quite significantly, putting pressure on margins. Again, this does vary significantly by market. It is generally has been the case that the places where the rents grew the most, because the economies grew the most, those places also where expenses grew the most. And whereas rents flatten out and go negative, I have begun to see NOI declines in some of these markets. And so it all becomes a question of, if you bought early in the cycle, you still have enough margin, I'm sure, to be quite well. If you bought late in the cycle in 21, 22, well, and if you finance it with variable rate debt or short-term rate, then you're going to be in some kind of bit of a challenge. We've kind of mentioned before how much expense. It's difficult to add new supply. There is a lot of multifamily new supply. But a lot of that perspective won't get built. Even a lot of the plan won't get built. The under construction will deliver over the next year and a half. And there are some markets with a lot of supply that will need to get absorbed. But again, come 26 and 29, they really have a break. And you are beginning to see that in starts. They are coming down significantly. And if I actually had the best estimate of Q2, it would be an even further decline. So the decline in starts is meaningful and is setting up, quite frankly, the next cycle. We do track starts by product type, across a range of products, and we are seeing the significant declines in markets where they had grown the most. And as we got the data on 24, we're going to see even a more pronounced effect than we saw in 2022 and 2023. The markets have effectively been very much disrupted. The bid-ask spreads there, as transactions are down 60, 70%. I do think that once there's clarity on interest rates and the path, trajectory of interest rates, then I think people will be able to underwrite that, and transaction volume, I think, will begin to pick up very late this year and early into next year as the economy slows. But again, that creates less uncertainty as to where things are going. There are properties that are going to crack under the pressure, however, and you can see the volume going down. Now, as we look at our forecast, we also did a long-range 20-year population forecast, looking at all these factors we've identified here. Some have a negative impact, some have a positive impact. And so, but you can see this at a national level, we do think right around 2040, right, is you begin to see national kind of leveling out of renter households, which then what becomes much more important is that you happen to be in the markets that continue to grow population. It's an important factor now. It will become an even more important factor into the future. We see national rental demand for younger Americans. There's just going to be fewer of them after 2037, 2038, unless there's a dramatic change in immigration policy. So that's where we're at. And we basically laid this out by age cohort because there are different implications of a different product type. But I think that basically puts a notion here of, yes, we're still going to have another 15 years of a rising renter population, even without the effect of kind of home ownership expense, which has created a bit of a tailwind for rentals. But going forward after 2040, we're going to have to look at where people are moving to critically. Quite frankly, multifamily performance in our forecast is actually not bad now. But remember, this sort of masks a bit of a rotation across markets. Some markets doing much better than others. And if we look at that and kind of go into this, you can kind of see that there are certain markets doing quite well, other markets with a lot of supply that needs to get absorbed, taking it on the chin, and they begin to come out of it at the back end of 2025. We do see this big supply decline in 26 and 27, 28 and 29. I'm assuming it kind of comes back, but there are some issues associated with that. Long run, the new supply isn't really going to be too much of a problem to absorb, but you do have a lot of supply now over the next 18 months and a dearth from 26, 27. Now, inside of that, if we look at the conditions of emerging stress, again, it's not, we cover 120,000 properties, 22 million units. It's not as if there's stress everywhere in the system. There is definitely not that. But for properties bought late in the cycle with short-term debt or floating rate debt or a construction loan initiated that is now delivering and expiring into this period of time, yes, there are properties that are problems that do need workouts, that are going to need to be restructured. It could be a capital opportunity for some folks. And that's really how we kind of lay out identifying those stress situations. If stress is beginning to emerge in certain situations, but it is highly concentrated in, again, I've got about a dozen, 15 or so high supply markets. Remember, we cover 180 markets. So it's just that these dozen are really big and they have a weight on the national averages of all kinds. But it is quite localized compared to the whole country. Now, you can kind of see here, there is a lot of stock that's getting delivered in these cities, and that is weighing on rents. But again, these units are getting absorbed. It is happening, but not necessarily at the rents that people would necessarily like. What has been an interesting feature, and I'll just direct your attention to the far right, is that the renewal lease trade-outs, renewal rents have hung in there through this period of time where new lease trade-outs have been negative. Now, that is beginning to level out and potentially decline, but that is a function of the big spread between new lease and renewal at actual rent levels. But again, that amount is basically has collapsed. And I do think renewal rents will move into the sort of flat to 2% range. But that is supporting overall revenue streams as new rents come in much lower. There are opportunities to find maturing loans in high supply markets. You can kind of see there's not gazillions of them, but there are several, in addition to construction loans and floating rate notes. So there are opportunities if you are a stress or distressed buyer, but you do have to be selective in your expectations of them. And as we kind of wrap up today, what I really wanted to say is, look, we've had a good run of economic growth. We had a big run up in COVID. We had a big inflation. We're now on the backside of both the economic growth and the inflation because of an significant increase in short-term interest rates that have slowed the economy down, allowed supply chains to catch up, reduced the amount of demand for labor overall. We are headed toward a slow recession in the late 24, I think early 25 period of time. And so, if you happen to be in a market that has a lot of supply delivering, it could be a difficult next year and a half. For other markets, it will be more of a demand issue.
to keep demand up. Overall, I think long term, if we go out past this transition period, the supply of U.S. housing has not been resolved. And so there's still significant benefits to being an owner and manager of residential real estate. There are challenges. I haven't covered the regulatory issues associated with that. It's not easy. And I think the political pressure in 26 and 27 will get worse depending upon where you operate in. And you should be prepared for that. And in all of these cases, looking for opportunities to save labor, to reduce cost, and to mitigate some of those pressures is going to stand you in good stead. Thank you very much. Have a wonderful day, and goodbye.